Hey, Jim Munchbach here. I just wanted to do a quick introduction. Today is the day that we at University of Houston, we do our favorite lesson, my favorite lesson, which is investment. 4 investment strategies to maximize returns and minimize risk. So I'm going to be posting, we're now, as you may know, if you're in the course, you certainly know, we're doing Zoom lessons remotely. So our class that meets at University of Houston that normally meets in person, we're no longer able to do that. So I'm having to do the class through Zoom. So I recorded the lesson. You're about to see that. I'm doing this introduction though because I'm going to post the whole lesson on our YouTube channel at millionaire-habits.com. That'll take you to the YouTube channel. But I'm asking that when you watch this video, especially if you're in the course, that you leave your comments and questions underneath, and I will be happy to answer those questions. So we're going to be jumping right in. I'll show some cool illustrations from my book, Make Your Money Count. That is the professor who is talking about investing, and this would be the clients, or in this case, the students who are maybe not quite as excited about investing as the professor is. At any rate, these are illustrations that are in my book, Make Your Money Count, and when we get together, again, if you're a student or a client or prospective client or just a friend, I love to give a copy away. It's a great book, and it outlines these strategies that we're going to go over today. So we're going to go over 4 investment strategies that can help you maximize return and minimize risk. Number 1 is diversification. Number 2 is asset allocation. Number 3 is dollar cost averaging. And number 4 is portfolio rebalancing. If you're an investor, you're probably familiar with these strategies. But if you're a student in my personal finance course, this may be new. So I wanted you to have a chance to watch the video and maybe take some notes and think about it and then ask any questions you have, and I'm happy to answer those questions. So again, we will jump right into 4 investment strategies to maximize returns and minimize risk, and I hope you enjoy the video, and please don't forget to leave your comments underneath this video. Thanks, and I'll see you next time. So we're going to talk about investments today. This is probably the most popular lesson in the course, certainly one of the funnest to teach, and if you follow the market, if you pay attention to the market, you may be seeing that we've gone through the last few weeks some really historic events relative to the stock market. So hopefully we can take advantage of some of that historic movement in the market, and I can illustrate and show you what I want to show you in today's lesson, which is really 4 investment strategies to help you maximize returns and minimize risk. So let me just quickly name those 4 strategies. And by the way, this is if you typically sometime in the semester I will give you a copy of my book, Make Your Money Count, and this book has some great illustrations. Like we're going to talk about Farmer Joe, and we're going to use one of the illustrations in the book to illustrate one of these strategies. And there it is in the book. And so I'm using the same illustration here. But at any rate, when you see this first image, this is me teaching investment strategies. And this is you. It's really to illustrate what it's like for clients to have someone like me go yammer, yammer, yammer around something that I'm very interested in. As you can see, I'm very interested, as this professor is, and yet typically the person listening doesn't really care that much. Now, I'm hoping that you care, because in terms of building wealth, managing your investments is pretty important. And you can either hire someone like me to manage your investments, or what most people do is, because they're not really informed, they buy mutual funds or some other investment that has built-in fees or loads or excessive costs that you don't even know about because you didn't do the research. And so that was your assignment this week. We'll touch on that. I'm going to try to interweave your assignment from this week around investment risk review. You were supposed to pretend you had $100,000, and you did the assignment, which was to go and identify and evaluate a mutual fund. And then you were supposed to tell me how you were going to allocate your imaginary $100,000 in terms of asset allocation. Okay, you're welcome to chime in if you have a question as we go forward, but I do want to jump in and take advantage of this time to talk about 4 investment strategies that can help you maximize your return and minimize your risk. Again, the 4 strategies are diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. So let's start with diversification. Diversification is, I like to think of this elevator. Uh, and the elevator just kind of shows if you're on an elevator with one cable and the cable breaks, you're in trouble. Uh, so if you're invested, if all of your investments are in one investment and that investment goes south, you're going to lose a lot of money. So the story I like to use to illustrate diversification is a company that used to be a very strong, very well-known company here in Houston. The name of the company, of course, is Enron. And Enron, I had a I had a client who worked at Enron at the time that they were going through their horror story, and she was in middle management, and she was very smart. She told me that during all of her time at Enron, she did not she diversified. She invested her 401k not in company stock. She did have some company stock, but not very much. But she invested in other asset classes, other assets, other investments. So she was diversified. So when Enron melted down, she did just fine. And she's still doing just fine. Had another client though, her name was Miss Eleanor. She was a little old lady. Her husband worked at Enron and his name was Bill. And he was kind of middle management as well. You could say he was making really good money and he had over $1 million saved in his 401k. And then Enron went through the trial by fire and they failed. But during that time that Enron was plummeting, the leaders at Enron were telling the employees, there's never been a better time to invest in Enron. And Bill believed them. And so he went and took his savings out and he just really doubled down buying Enron stock because, hey, it was on sale. As a result, when Enron finally basically liquidated and went out of business, uh, he lost everything. And Bill, at that point, he was suffering from tremendous anxiety and stress. He had a heart attack and he died. That left Eleanor, his widow, with nothing, basically with nothing. And my wife was a teacher and she actually worked with this lady was a teacher's aide. So that was the only job she really qualified for. She hadn't been in the workforce and she had to work. Uh, and so that's the story I like to use to help you understand that when it comes to investing, when it comes to investment strategies, the most simple, the most boring, yet really one of the most important strategies or principles of investing is diversification. So you're going to have plenty of opportunities in your life where somebody's going to say, "Hey, you should check out this stock. It's a penny stock or whatever, and you got to get in. It's just going to skyrocket." Well, you know, I mean, if you're going to do that, do it with small amounts of money. Don't do it with large amounts of money. Don't do it with your main retirement investments. So that's the first principle of investing. The first strategy is diversification. So before I get into the second strategy, I want to illustrate or highlight one of the uh, one of the homework assignments that I saw. So you were supposed to assume that you had $100,000 to invest. You were supposed to go out and find a great mutual fund to invest. And then you were supposed to tell me how you were going to allocate your $100,000. So this student, hopefully don't, the student's name isn't here, but this student said, I'm going to invest 10% in small cap, 20% in mid cap, 20% in large cap, 10% in international, and 40% in bonds. Now, there are lots of problems with this allocation. For one thing, I would say, okay, I'm assuming this is a young person who has a long time to invest. So what I want to do is just help you understand that different asset classes perform very differently. So for example, I'm going to show you the charts on some of these investments. I'm going to show you a chart for a large cap. I'm going to show you a chart for a mid cap, and I'm going to show you a chart for small cap, and I'm going to show you a chart for bonds. I know that some of you understand the differences between each of these asset classes, but I'm also assuming that most of you don't really get the difference between asset classes. So I just want to kind of try to illustrate a little bit. A large cap will go from large cap to mid cap to small cap to international, and then we'll talk about bonds. So that's large, mid, small, international, and bonds, 5 different asset classes. There are a lot of different asset classes, but let's start with those 5. So what do you think a large cap stock would be? Think of companies. What is a large cap stock? What do you think? Anybody, what do you think a large cap stock is?
Apple?
Nathan,
Would it be Apple?
why do you say Apple?
I thought large cap would be like big companies that are like
There,
pretty.
yep, there you go. That's a large cap company. It wasn't always a large cap company, but it certainly is today. So any other
Isn't it more than 5 billion?
you know, it that was you, Baylor?
Yeah.
I think it is. I'm not really sure what
When
the
I looked it up
number
last
is.
night, I think that's what the number was.
5 billion or
Yeah,
500?
5 billion.
Yeah, that makes sense. So when I think of large cap, I think of the S&P 500. So the S&P 500, I'm going to show you a chart. My favorite way to trade the S&P 500 is the SPY. It's an ETF. So I ask you guys to look at mutual funds. Mutual funds are fine. Dave Ramsey likes mutual funds. A mutual fund involves a manager. Part of your homework assignment was to evaluate the mutual fund, and you were supposed to tell me about the manager, because that's one of the things you get with a mutual fund is a manager. Does anybody know what else you get when you invest in a mutual fund? What is a manager, having a manager, do to the cost of your investing? Did anybody address that? Because I didn't see that very clearly in most of your assignments, and I haven't graded all of them, but does anybody know the difference between an ETF and a mutual fund? So I'm not going to spend a lot of time on that, but I am going to just help you understand that with a mutual fund, you get a manager. So when we look at this illustration of this elevator, if you had a mutual fund managing your fund, instead of having one fund or one investment, you're going to have multiple. And so the mutual fund manager, his job's going to be, or her job will be, to inspect those cables all the time and find out what are the best cables we can put in this elevator to make sure that it's strong, not just diversified, but we want the best companies in that, in that mutual fund. And you pay for that. You pay to have a mutual fund manager manage which company stocks are in your fund. So with an ETF like SPY, instead of paying a manager, there's very low fees on this. You could actually invest in the SPY as your allocation to large cap. You could put it right in the SPY. Now look at this chart. This is a 2-year chart. And just tell me, what do you see when you look at that chart? A 2-year chart of the SPY, which is a representative of the S&P 500. All 500 companies in the S&P 500 are part of this ETF. What do you see when you look at this chart?
There's a
Marzia?
Yeah, Marzia.
What did you?
Sorry. There's a lot of like fluctuation in the pricing and of the company.
Yeah, this is a 2-year chart. That's right. You see a lot of volatility or fluctuation. Now, what do you see in that chart over the long term? This is the chart that goes from like 1993 up until now. What do you see in that chart?
Oh, it comparative to the other chart, it seems a little bit more stable, I guess, since it's like.
So that's the S&P 500. Over the long term, does it go up or down?
It goes up.
Yeah, it goes up. But if we let's just look at 6 months and see what had happened in the last 6 months. Wow. What if we look at 3 months? See if I can get that 3-month chart to pop up. Wow. So if you invested your $100,000 in the SPY at the beginning of the year, and you're looking at this chart now, and you see that it went from way up here to way down here, that's a big loss, like 30%, which means your $100,000 would turn into like 70 grand. That's a large cap. But over time, if you just stick with it, over time, you're going to make money. And that's why I want you guys to understand asset allocation is really important, that you look at the asset class that you're investing in. So look at that chart. That's a max chart for a mid cap stock. Kind of looks a lot like the S&P 500. By the way, look at today. Just in today, the S&P 500 has gone up, and in the last few days, it's gone up a lot. So the S&P 500 is going up, mid caps are going up, and this is a small cap right here. If you look at that asset class, it had the same, these are small companies. What has more risk, a large company or a small company?
Small companies.
Why is that?
I guess large companies have been there for like a long time. They know like if something like this pandemic comes around, they can hold on. Whereas like small companies, they won't be able to like stabilize themselves, and they might lose money during this time right now. So.
And you can see that reflected in this chart, how far the small cap, this is a chart from 2001 to now. Look how much they fell, because investors believe that these small companies are probably, a lot of them are not going to stay in business. So if you had money to invest today, do you think you'd want to invest in small cap companies today? A smart investor would say, yeah, because look how much they came down. This is an ETF, so it's not one company. It's a whole basket of small companies, but that's a different asset class. Now let's look at a bond. Can anybody tell me what a bond is, the definition of a bond?
Isn't it like debt to a company?
Yeah, like a company, instead of selling equity shares in their company, they put out a bond and the investors buy the bond, and then the company pays the interest. So it's debt. And that's what TLT is. It's government bonds, actually, not corporate bonds. But bonds tend to, because they're a different asset class, bonds tend to go up when equities go down. That's not always true, but typically it's true. So as far as an asset class, when you set up your portfolio, it's a good idea to have some bonds in there, because look at this chart and tell me what you see from the beginning back in 2003 until now. What is that chart doing? It's gone up, up, and up. Let's look at a 6-month chart. When we look at a 6-month chart on, and remember, I'll take you back to a 6-month chart for the, boy, that is a bizarre chart, but look at the high point right here. So that high point corresponds in bonds, this bond ETF, compared to this SPY. That high that we saw just a minute ago corresponds with this low right here. Do you see that? So that's why different asset classes do different things. They respond differently to market forces. So when you select your asset allocation is the second strategy. The second strategy that can help you maximize return and minimize risk is asset allocation. That's the most important determinant of your portfolio's outcomes or returns. And so it's one of the reasons you do this assignment. And in this particular case, the student said that they chose this mutual fund, WHO. That scares me that the fund has that in it, the WHO, World Health Organization, just a coincidence. But it has been around for a long time, so that made them feel credible. 24 years, 10 years after the inception of the fund. And look what it holds. What is that Those are bonds. So this student is saying they're putting 0 in bonds, but this is their favorite fund. And so I'm just pointing out that, oops, that's not exactly accurate. So this bond, however much of this holding you put into your portfolio, should be reflected here in bonds. That's all I was saying. So let me show you, I think I have, and here's another homework assignment that I found was interesting. So this student selected some really good funds. They started with the idea of social responsibility, which is really nice, but it doesn't always work so well as far as returns. In this case, the student selected these funds, and you can see 60% in large cap. So I kind of like this: international, small cap, mid cap, no bonds. That's a very aggressive portfolio, doesn't have any bonds in it. But here's what, so without bonds, I'd say there's not a good, it doesn't have good asset allocation. Um, you want to have some bonds, even if you're young. Asset allocation, question mark. So it doesn't have bonds, which I would say would be a good idea to have some bonds. You've got all these equities here that are pretty, that didn't work, that are pretty aggressive: small cap, mid cap, large cap, and international, very aggressive. So here's the other thing about asset allocation and diversification. These particular funds that the student selected, look how many of them have Microsoft and Apple. And that's one of the problems you get into when you invest in a mutual fund. If you don't know what you're investing in, you can have a lot of overlap. So I'm not saying Apple or Microsoft are not great companies to be invested in, but you want to be diversified. And in this particular case, you have a tremendous amount of exposure to equities, large cap, and specific companies that makes this portfolio not very well diversified, and certainly isn't taking advantage of proper asset allocation. So that's going to cost some pain in the event of the kind of market collapse that we had in the last few months. So here what I did is I just did a quick report. It's a portfolio analysis report. And this goes back to the portfolio. Let me show you oh, my pencil's dying. So I want to show you this assignment right here. So this is basically the portfolio that I'm illustrating. So I'm taking that portfolio and I'm saying, here's what it looks like if you put it under the microscope. Risk number, 45. And if you look at the 6-month probability based on the asset allocation, the selection of what we have in this portfolio. And again, that's what we're looking at in these charts. So I have those same funds right here, and you can look at the charts and you can see how they responded. But if you take that portfolio, put it under the microscope, and ask, okay, what's it going to do? Well, in 6 months, 95% probability that it's going to go down 8.2% or up 13.7%. Is that okay with you? What do you think if that was your $100,000? To have a $13,000 gain as the upside if the market does really well, and to lose 8.2%, $8,000 if the market has another hiccup like we've seen. Nobody knows if the market's going to go up or down, but that's the portfolio and that's your risk profile for that portfolio. So what do you think? That's what I'm looking for when I do an analysis, before I give recommendations on an investment. I want to know what you have and what it's looking like so that you can see that. And this is what that portfolio that student put together would look like. Here's another metric. And you should, when you analyze a mutual fund or any investment, you want to know what kind of distribution rate, what kind of dividend, what's the extra kind of juice that it's going to pay you in terms of return on your investment. And this portfolio has a 1.4%. The expense ratio is very low, and mostly because it's got 30% in cash. Now, you recall that student actually had 40% in cash, which is not a great portfolio mix. And I just went ahead and added 20% bonds. So you can see that this portfolio, that's what it would look like. Here's the portfolio that I'm recommending these days. It's a little bit higher risk number. And look at this. in 6 months, the probability, 95% probability that this portfolio will lose 13.9%. But it also has 95% probability within 6 months that if the market does well and bounces up after this huge pullback, then this portfolio would go up 20.8%. Pretty, I'd say this is a pretty aggressive portfolio. But look at, you're not losing that much in terms of risk between these two, 8% and 13%. That might seem like a lot, but to have this kind of upside versus that kind of upside, that's, you know, almost, it's a lot more upside. Now look at the distribution. And again, these are all ETFs, and the distribution is 2.34% instead of 1.4%. And then the expense ratio is a little bit higher, but it's not that high. So that's how I would analyze a portfolio to, you know, make recommendations. And I could talk about each one of these holdings. I'm not going to do that now, but I just want you to know that this portfolio uses asset allocation in a way that helps to cushion the downturns and give you a pretty good upside opportunity. So for a young person, I think this would be a really good portfolio. In fact, for an older person who's got money that they're willing to leave in the market for a while, they don't need it right now in the next 6 months, then this is, I think, a good portfolio. So now I just got a notice. Did anybody see that notice that popped up on the screen? It said your portfolio has been rebalanced. How timely is that? So I have my money at Charles Schwab, and one of my accounts is it's operated by an algorithm, and it gets rebalanced on a regular basis without me doing anything. So that's one of the investment strategies that I'm recommending. One of the ones we're going to talk about today is portfolio rebalancing, but that comes after we talk about Farmer Joe and dollar cost averaging, which is the next investment strategy. So we've talked about diversification, not having all your eggs in one basket. It's probably the most important investment strategy. Second is asset allocation, which is absolutely the most important investment strategy in terms of your portfolio's outcomes. So you can lose a lot of money if you're not diversified, if you have too much in one investment. But so that's the basic investment principle, is diversification. But asset allocation, it's a little more complex. And that's why I wanted to spend some time and help you understand that there are differences between asset classes. And different asset classes, they respond different to market volatility. Bonds tend to go up when the market's having a really bad day. So it's good to have both of those, bonds and equities, but also large cap and small cap. They have a different rhythm, different risk profile, but you want to be investing in small cap stocks as well and mid cap stocks, because there's more, with more risk comes more opportunity. And so managing risk and reward is really the whole point of this lesson, and these 4 investment strategies that help you maximize return and minimize risk. So diversification, asset allocation, and now we're going to talk about dollar cost averaging. Dollar cost averaging is, in my opinion, the most, well, I think it's scientifically proven. It's the most important or the most powerful strategy that you can employ over time. So I'm going to explain dollar cost averaging using my Farmer Joe analogy. So Farmer Joe, he's a client. Farmer Joe calls me up and he says, you know, Jim, I think I'd like to invest in cows. And at the time that he called me, cows were selling for $100 a head. And it just seemed like they'd gone up and up. And he thought, you know, people are eating beef and hamburgers are in, and he's thinking all these ways he could make money if he invested in cows. So they're selling at $100 a head. And, you know, I said, we need a strategy, Joe. We need an investment strategy. Let's figure out what can you afford? How much cash flow do you have? Yada, yada, yada. And we came up with Joe was going to invest $100 a month. So we start out month 1, cows are $100 a head, and he buys 1 cow. The next month, cows drop to $50 a month. How many cows does Joe buy that month? He's going to invest $100 every month. Cows drop to $50 a month a head. How much is he going to get? How many cows will he get? two cows. So month 3 comes along and cows drop down to 25 bucks a head. And Joe gets 4 of them that month because he's putting $100 a month into cows, and cows are now 25 bucks a head. That's 4 cows. He gets 4 cows. The next month, month 1, 2, 3, and 4, month 4, cows drop to 20 bucks a head. This is when Joe calls me, and he is alarmed. He's like, it's kind of like this. It's kind of like I got this call from a client who was investing in the S&P 500, and it went from $100 a head to 20 bucks a head. And he's saying, my client is saying, I want to sell everything. I want to sell everything. I'm scared to death that it's going to keep going down. And I'm like, Joe, wait a minute. 4 months ago, you were spending $100 a head on cows. What's changed? Do you still need cows? Are you still thinking people are going to eat hamburger? People still going to be grilling T-bone steaks in their backyard when they can't go anywhere in a lockdown? Do you really think that beef products and leather and all the things you're going to do with your cows are now no good, useless, worthless? Do you really think cows are going to stay at 20 bucks a head? If I were you, Joe, I'd go sell your tractor and I'd buy more cows. What would you do? What would you tell Joe? So he's like, okay, I'll buy 5 cows this month, but I sure don't feel good about it. I'm like, you'll feel better soon. Next month, cows go back up to 25 bucks a head. How many cows does Joe buy? He buys 4. The next month, now we're in month 1, 2, 3, 4, 5, month 6, cows go back up to 50 bucks. 50 bucks. He buys 2. Now the 7th month comes along, month 1, 2, 3, 4, 5, 6, 7 months, not even a year, 7 months, cows are back to where they started, $100 a head. They never went over $100 a head. Now Joe calls me. He's like, you know what? I got a lot of cows. And I'm thinking, it's just, I think I want to sell my cows because I'm not really comfortable with this price going up and down. And I've thought about it and I just can't sleep at night. So he sells his cows. Now, somebody tell me, how many cows did Joe buy over 7 months? Anybody? Can you count them? Somebody? I'm not gonna answer this one for you. Anybody? For an extra 18? Anybody count 18? 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16,
I
17.
think I got 19.
Tina, thank you. I think I ran out of fingers, but yeah. So Farmer Joe bought 19 cows in 7 months, right? That's what I counted to. Now, how much are the cows? Uh-oh. Sorry, I lost my screen. Hopefully you can still see me. So how much are these cows worth today? He bought 19 cows, and how much are they worth? This is really easy.
$100 a piece.
So that's a total of how much?
1900.
1900. And how much did he actually invest? For 7 months, he invested how much?
700.
He invested 700. So his investment was 700, which nets him how much? If he sells his cows, how much does he net? What's his profit? 1200. 1200 bucks. And guess what? Cows never went over 100 bucks. Joe just took this principle, this investment strategy called dollar cost averaging, and he did it over time while the market went up and down. And because he was doing this systematic strategy called dollar cost averaging, he was able to make money. Now, he decided to take his profits because Joe's a pretty savvy investor. And he just, he figured he can always come back and buy cows if they drop down to 20, but he's done buying cows at 100 because he saw what can happen. He made his money. He's checking out. Now he's going to go buy chickens because they're on sale. So that's dollar cost averaging. And that's how it works. Now I want you just to put your thinking cap on and imagine if instead of buying cows, you're buying shares of large cap stocks. Maybe it's an ETF like the SPY. And systematically, every month, let's go back to that perfect investment, your 401k, where you're investing and the company is matching. Well, you have that opportunity in your 401k. You select the asset allocation. So, for example, you could say that you're investing in large cap, small cap, mid cap, and bonds, or maybe large cap, mid cap, international, and bonds. That'd be four different things. It's like cows, chickens, pigs, and goats, just like Farmer Joe and the cows. But you're doing a systematic investment and your company's matching your contribution. And every month or twice a month, that money is buying those different asset classes as they go up and down. And over time, because you did it in a systematic way, on the months where those asset classes were down, you were buying more, just like Farmer Joe and the cows. And in the months where those were higher, you were buying less of those and more of the other one that was down. But over time, dollar cost averaging is the most powerful investment strategy to help you maximize your return and minimize your risk. It works so well over time. So it's really one of my favorite investment strategies, especially for folks who are younger. So I'm going to pause, and we've covered three of the investment strategies: diversification, asset allocation, and dollar cost averaging. And I want to give you guys a chance to think and ask questions and maybe have a little conversation before we jump into the last one, which is portfolio rebalancing. Questions, comments? Somebody tell me that you got it, that this is like, oh, I get it. This makes sense. Anybody?
So
But
far, it makes sense.
Say that again, Nathan.
So far, it makes sense.
So does it make sense to you that you could do this with your 401k?
So, yeah, about that, when you're at your, whatever company you work for, you would just tell them that you want to like diversify your accounts like this. Like they would have an option where you can,
Yep.
but then
When
they
you're
would take care of that. Like they would actually split it up for you, or do you have to like tell them each month that I want to put it into this?
That's a great question. So I want you just to imagine that it's your first day on the job. Typically, you go through orientation. You're going to sit with an HR person, human resources, and they're going to help you fill out all the forms that you need to fill out so that you have your parking pass, and you have the right deductible on your health insurance, and you have the right 401k. Like, do you want to contribute? Yes. How much do you want to contribute? Oh, wait, what's the match? Oh, it's 8%. How much are you making? You're making, pretend you're making 100 grand. So because we've gone over this 3 times, that it's an absolute no-brainer that if you're making 100 grand and you're signing up for your first day on the job, you're going to say, yeah, I want to contribute, of course. And how much are you going to want to contribute annually to your 401k if they're giving you an 8% match and you
At,
make 100 grand?
at least
How
eight.
much? Yeah, exactly. At least 8 grand. So that's check. Yes, I'm going to contribute 8,000 annually. So they'll figure out how much per paycheck. They'll do that for you. And then they're going to say, okay, what do you want to invest it in? Well, you're putting it in your 401k. That's a type of account, but that doesn't answer the question, what are you going to invest in? And that's where you're going to be thinking asset classes. And you're going to look at your options and you're going to see, oh, there's a large cap S&P 500 index fund. The options are going to be limited, but you're going to see that you have an option for large cap. You have an option for mid cap. You have an option for bonds. You have an option for international. You're going to see, oh, yeah, I have an option for all of the asset classes that we talked about in these investment strategies. And you're going to say, okay, 25%, 25%, 25%, 25%. Fine, perfect. Maybe you want to be a little more aggressive and you want to do 20% in bonds, 40% in large cap. I don't care. It doesn't make a huge difference. I mean, you want to be thinking about that, depending on what your options are. But that's it, Nathan. You're checking the boxes saying, yeah, I'm going to do some in that. HR is going to be like, good call, that's smart. And after that, it's autopilot. It's automatically coming out of your check. They're automatically matching it. They're automatically going out and buying cows, chickens, pigs, and goats, large cap, mid cap, international, and bonds. And month after month, week after week, as those asset classes go up and down, you are taking advantage of dollar cost averaging, which again is the most powerful investment strategy to help you maximize returns and minimize risk, because your systematic plan lets you buy those assets in a systematic way so that when the price is down, you buy more. And when the price is high, you're buying less of that and more of something else. And that's how it works. And it works really well in a 401k plan. Great question, Nathan. Anyone else? Okay, then it's time to move on to the fourth and final investment strategy designed to help you maximize returns and minimize risk. So we've covered diversification, we've covered asset allocation. Diversification is probably the most important. Asset allocation is clearly scientifically proven to be the most important determinant of your portfolio's outcomes or returns. Diversification just keeps you from going broke. Um, but asset allocation is where you actually can maximize your returns and minimize your risk. The third strategy, dollar cost averaging, is the most powerful strategy to help you maximize your returns and minimize risk, because the way it works in a systematic way, it just works. And so the fourth and final investment strategy is portfolio rebalancing. So I like to use the illustration of tires. I used to be a master mechanic. I worked at Goodyear Tire, J.C. Penney, places you've never even heard of because they're not in business, Montgomery Ward, Sears. I worked in retail, but I was a mechanic, a master mechanic, and I started in the tire lane, installing tires. That's one of the ways I paid for college. But when you balance a tire, what you do, you see that little weight right there. When tires are made, they're not perfectly round, they're not perfectly balanced. So you have to put weights in different places. You spin the tire and it tells you, the machine will tell you where the tire is out of balance. So you add. And so that's what I want you to think about in your portfolio. Having a well balanced portfolio means you have good asset allocation and it's balanced in the way you want it to be balanced. But over time, because of asset classes going up and down at different times over periods of time, your portfolio gets out of balance. So if I drew a picture of a portfolio, let's just say this is your portfolio. And inside your portfolio, you have, let's just say you have uh, 4 quadrants. And we'll say large cap, small cap, international, and bonds. So you have 25% of everything there. But over time, let's say that the S&P 500 goes way up and bonds go down. So now down the road, and let's say international goes down, small cap goes down. So now let's just say that your large cap, it's like this much. It's what, 35% instead of 25%. So what we have to do is we have to put it back in balance. And that's where portfolio rebalancing comes in. You would then, at that point, just like Farmer Joe sold the cows, you would sell off some of your large cap, and international is way down. So you would then come over here and you'd buy some more international. When you rebalance your portfolio, like that little reminder or notification that I got, it said my portfolio was rebalanced. And that's probably what happened. They probably sold off some large cap and bought some small cap, because small cap is really under pressure right now. So over time, rebalancing your portfolio acts kind of like dollar cost averaging. Do you see that? Where over time, you're selling off as cows are really high and chickens are really low. You're going to sell some cows and buy some chickens while the chickens are on sale and the cows are at a really high price, and vice versa. So that's portfolio rebalancing, and that's kind of how that works, so that your portfolio stays balanced in the way that you want it to be balanced in terms of asset allocation. Any questions about portfolio rebalancing? Is really just putting your asset allocation back the way it was supposed to be. And when you do that, it means selling some and buying some. And typically you're selling what grew and buying what shrunk, and then you're back in balance until next time. and then you do it again. And in the meantime, you're still doing your systematic investing, your dollar cost averaging, so that you're buying each asset class in a systematic way, so that as those prices go down, you're getting more shares. And as the prices go up, you're buying fewer shares, because that's how you're managing risk. Dollar cost averaging. And then portfolio rebalancing is something that happens every 6 months, every year. And typically, you can set that up in your 401k to be done automatically, or you may have to go in, click a button, and rebalance it. And you may have to set a reminder to do that, depending on the plan that your employer set up at work with your 401k. Same thing is true with your other accounts. You can do these same strategies in an IRA or just a brokerage account, but it really works well. These strategies really work well in your 401k. So, any questions,
I
comments?
I got
Yes.
one. Is there any like app or website that you'd recommend that kind of helps with visualizing these things, or that help us like follow these steps better, or maybe just looking at our investments hand
I
over
mean,
there?
yeah, if you don't actually have investments, you might want to set up an account where you can do paper trading and, set up a portfolio and see what would happen if you took an imaginary $100,000 and invested it, and then you can track and follow that. TD Ameritrade has a paper trading, so you can set up a fake, it's a real account, but you basically paper trade, and that would give you I think, a good base of experience for how this works. There are lots of apps out there that can help you see different views of the market or of different investments, but I don't know what to say. I don't know of an app that helps you experience all of that. Mint.com is a good start. If you actually have investment accounts, the key is to be able to see what's going on with those investments over time. Are they going up or down, and where are they going up or down? We use tools like that in wealth management, but I don't know of any apps that replicate that very well. Any other questions? Well, then I'm going to wrap it up. And I think we covered the 4 investment strategies. We even talked a little bit about the perfect investment again. Next week, we're going to talk about types of accounts. So again, the second law of personal finance is the law of tax advantaged investing. And in order to do that, you have to understand different types of accounts. So you're going to be learning that this week as you study. And next week in the lesson, I will try to put that all together. And hopefully what you learned today about asset classes and investment strategies, once we put that all together into types of accounts, you will have a really good foundation for tax advantaged investing. And you'll be able to see how it really isn't that difficult to become a millionaire by the time you're 50 if you just employ these strategies and these small steps that you're learning this semester. So thanks for being here. I'm going to try to maybe take this video and post it if it came out okay. It's kind of long. I might cut out some of the administrative stuff we did at the beginning, but hopefully this was helpful. Once I post it on YouTube, if you have questions or comments, I would love to see those, and I'll absolutely answer them when I see them. So if there are no questions now, going once, going twice, we're gone. Y'all take care.